This is the video for Thursday, April 22nd and Friday, April 23rd. I was unexpectedly absent on Thursday, April 22nd, so I'm going to have to do both videos today. So we're going to start with the bell work for today. Jack, Brooke, and Caroline are chatting after school about a new special edition comic book that just exploded on the scene. One of the friends owns a signed comic acquired before the author and artist became famous, while the other two friends are eager to get their hands on a signed copy. Read the scenarios and decide if Jack should sell his comic to Brooke, make a trade with Caroline, or hold on to his signed comic. So, here are the scenarios about what is going to happen here. So Jack collects comic books, and last year he went to the local convention to check out some new artists. He found one he thought was amazing and decided to buy an autographed comic book by him and show at the show for $5. Fast forward 1 year, and the author is now hugely popular, with everyone clamoring to buy his comics. Autographed comic books are flying off the local shelves at $25 each, and some are even selling for $50 online. Jack's unsure if he should keep the comic, trade it, or sell it now that it's worth more money. Brooke, the buyer. Brooke collects rare and original comic books. She loves the new series and needs an autographed copy of the original comic book to add to her collection. She's willing to pay whatever it takes to buy it from him and offers Jack $100 for it. And last, Caroline, the trader, says Caroline would really like to have a signed copy of the comic book, but there's no way she can afford to pay $25 or $50 to buy one. She does have 3 comic books from another author that she, Jack, and Caroline like a lot. She offers Jack 3 of her comic books for his autographed copy. All right, so should Jack sell, hold, or trade, and why? Pause the video to answer that question and make sure that you give me a why. There really is no right or wrong answer here. It's just going to be what you think is best. All right, so one common investment strategy is buying stocks. What do you know about the stock market? Go ahead and answer it in that box. You should know a few things. We've talked about it already in this class. So buying a stock means that you are buying a share or a portion of ownership of a company. So if you buy a stock in General Motors, you become a partial owner of General Motors. You then share in the profits. A share has a dollar value, and there are many theories about how this dollar value is determined. So factors include how investors feel about the company and the products or services it provides. So do investors feel like things are going to go well, things are going to go poorly, stock's going to go up, stock's going to go down? That's all going to be a factor in how the stock performs. Supply and demand of the stock in that market. Even if everybody feels really good about it, if a lot of people are selling it at the same time, the stock's going to go down based on supply and demand. Well, you can also sort of see, though, that if everybody feels good about it, they're not all going to be selling it at the same time. They're going to be holding on to it. So usually when people feel bad, they sell. When people feel good, they buy. And it's that supply and demand issue that raises and lowers stock prices. And then price to earnings ratio, that's PE ratio. We talked about that in the video we watched a couple days ago, which is the measure of the price paid for a share compared to the annual profit earned per share. So I say that we have this, when you are an owner of the stock, you're a part owner of the company, you partake in the profits. You make money based on how that stock performs. And if you are paying a high price for the stock and you're getting a low amount of money in return, will be a low or a bad PE ratio. Now, we have a couple other things that I sort of want to talk about. One is we're talking about growth stocks, and growth stocks are stocks that are not even meant to give you a profit. A growth stock would be a stock like Amazon, where all the money that Amazon makes in a year, they don't pay to their shareholders in dividends. They put it back into the company, and that's why the price of Amazon stock goes up the way that it does. So there's 2 different types of stocks, and you have to be careful about whether you're buying a stock that's going to give you a high yield or a stock that is going to give you it's going to grow rapidly because they're taking that dividend money that you would make and they're putting it back into the company. And those stocks that give you a good amount of earnings are either called dividend stocks or value stocks, depending on what term you're using. All right, so how do you think investors choose stocks to purchase? And how do they ensure they get a strong return on investment? Well, there are several factors investors may consider when assessing investment potential in stocks, including studying market reports, finding companies that match their values, and observing trends and picking stocks from multiple industries to diversify investments. So when you did this, when you were buying your stocks, you were probably looking at different charts and you were looking and seeing how stocks went up and down. How has it gone up in the last month? How has it gone up in the last week? Is it in a high point or a low point? And when you try to just look at the line on a stock market graph, you're really having problems, because if you look at the line, and this is Amazon stock so far this year. So at any point you could say, all right, buy low, sell high. What am I going to do? It's gone up over since January. It's gone up over the last 6 months. A lot of highs and lows. Over the last month, it's gone up. Over the last 5 days, look, it's gone down. Yesterday, it went down. So if you look at the year to date of Amazon stock, if you're trying to time the market, you could have problems, because you could say, all right, well, I want to buy it when it's low. And so, look, it drops to here and then it starts to go up. And you say, all right, well, I'm going to buy it because it's starting to go back up. I'm buying low. This is low, because it was just way up here at much higher at 33,380. I'm buying it way down here at 3,180. So I'm buying it at a value. And then it immediately drops, and now you're wondering, well, is it dropping because is it going to keep dropping further? And so you sell down here. So when you just try to play the lines, when you just try to mess around and buy low, sell high based on the lines on the graph, that's really difficult, because you don't actually get to see what's next in the graph. You have to project based on where you think it's going to go. And so usually the savvy investors are investing in the companies. They're buying into stocks that are matching their values, or they're buying into stocks that are likely to grow in a certain way. And then they observe trends. They notice that, okay, well, tech stocks are going to be having some troubles right now, so we're going to sell the tech stocks because Congress is doing investigations into tech or something like that. Or Bitcoin-based stocks are going up right now because Congress is spending a lot of money. Whatever it is, you have to be sort of wary of that and careful and sort of understand the trends of all the stocks as a whole. Okay, so a stockbroker is a professional that helps investors buy, sell, and trade stocks on the stock exchange. If you're doing this in large amounts, I would suggest that you find a stockbroker. But most of us are going to be doing this in small amounts. And actually, you don't even really need a stockbroker. You need a financial advisor, and your financial advisor will then plug you probably into mutual fund. But for you and I, we're probably likely to use Robinhood or Cash App or something like that, because we're going to be buying and selling small amounts of stock. I would actually recommend that you don't buy single stocks because they are very risky. I prefer mutual funds myself. There are 3 major stock exchanges in the United States: the New York Stock Exchange, American Stock Exchange, and National Association of Securities Dealers Automated Quotations. That's NASDAQ. Okay. So how do stocks make money? Stocks make money in 2 ways. One is capital gains, and you just need to do this first bold one right here, which is when the when the value of a stock increases. So, for example, if you buy a stock for $50 and sell it for $55, you had a capital gain of $5. When you sell your stock, you pay a capital gain tax on that gain.
15% if you've held longer than 1 year, and 24% if you've held less than 1 year. So this is what happens when you play that line, when you buy low and sell high. This is day trading, right? This is the value of the stock goes up, and when the value of the stock goes up, I make money because I can now sell it for more money. That is capital gains. The other one is dividends, and a dividend is when a company makes a profit, quarterly or annual, or one-time payments of company profits to their shareholders or stock owners. That is a dividend. So this is you sharing in the profits as an owner of that company. Okay, so stocks have one of the highest risk-reward ratios of any traditional investment. Why do you think stocks are so risky? How do you feel about high risk and reward investments? And how much of your investment portfolio would you be comfortable with investing in a single stock? So answer those questions in your notes. For me, stocks are really risky because you're buying one company, and you never know what could happen with one company. There could be a fire at a factory. There could be a CEO that says something that gets the company boycotted. There's all kinds of different things that could happen with that company. They could have all of their supplies stuck in the Suez Canal. You just never know what it's going to be. And then how you feel about high risk and reward investments is really going to be up to you. I like to use the phrase that wealth is built like a crock pot, not a microwave. It's a slow thing. And if you try to be impatient with it and have those really, really risky investments, it's not likely to go well for you. And then how much of your investment portfolio would you be comfortable investing in a single stock? For me, this answer is always going to be different based on my personal situation. I don't have any of my portfolio invested in a single stock right now. Now, once I have made enough money, once I've paid off my house, once I find that I'm comfortable, I can then start to invest money in a single stock. But I would never put more than 10% of my investment portfolio into a single stock. But that's just me. You tell me how you feel about that. Okay, so the rest of the thing for today, we've got this how to read a stock table right here. You can open this up. You've got these terms. Obviously, scroll in on that. And you can use these terms to answer these blanks, fill these blanks in, shouldn't take long. And then these questions are just based on your own thinking and memory. Thinking back to our stock market game, out of the stocks you chose, which stock performed best, and then which stock performed the worst. So think about that, answer those questions, and that should be it for your notes. We got more. Pick any 5 stocks from the New York Stock Exchange to research and complete the following table. Stock name, 52-week high, 52-week low, stock symbol, yield, rate of return, price to earnings ratio, and last close. So research these, answer these questions. And then based on the stocks that you chose, how did each stock perform? Which stock closed the highest and lowest? Which stock had the greatest rate of return? Answer those questions. Make sure that you do this. I'm sorry that today's lesson is going to take you probably as long as it is, but that's because I was out yesterday, and hopefully you took advantage of yesterday's time in class to complete your Smart About Money assignment, which is a major grade and is due on Sunday. If you have any questions, please feel free to reach out.